Hello everyone, welcome back to 5-Minute Finance. I'm your host, and today we are diving into the tax implications of property transactions. Understanding these implications is crucial for making informed decisions in real estate investments. Let's explore how property transactions are taxed and strategies to minimize tax liability. Property transactions involve the buying, selling, and transferring of real estate, intellectual property, appreciating assets, and businesses. These transactions can trigger various tax consequences, including capital gains tax, depreciation recapture, and transfer taxes. When you buy a property, several tax considerations must be kept in mind, such as property taxes, mortgage interest deductions, and closing costs. Property taxes are levied by local governments based on the assessed value of the property. Mortgage interest on your primary residence is generally deductible, which can reduce your taxable income. Closing costs, such as loan origination fees and title insurance, may also be deductible in some cases. Let's visit the tax implications of selling property. Selling a property can trigger capital gains tax if the property has appreciated in value. The gain is calculated as the difference between the sale price and your adjusted basis, which includes the purchase price plus improvements and closing costs. If you've owned the property for more than a year, it qualifies for long-term capital gains tax rates, which are lower than ordinary income tax rates. Homeowners may also qualify for a capital gains exclusion of up to $250,000, $500,000 for married couples, if the property was their primary residence for at least 2 of the last 5 years. Owning property comes with ongoing tax responsibilities, including property taxes and potential rental income taxes. Property taxes are assessed annually and can be a significant expense. If you rent out your property, the rental income is taxable, but you can also deduct expenses such as repairs, maintenance, and depreciation. Depreciation allows you to deduct a portion of the property's value each year, which can offset rental income and reduce your tax liability. Property can also play a crucial role in estate planning. Transferring property to heirs can have tax implications, such as estate tax and inheritance tax. Using trusts and other estate planning tools can help minimize these taxes and ensure a smooth transfer of property. Here's a breakdown of the key tax considerations. Capital gains tax. When you sell a property for more than you paid for it, the profit is subject to capital gains tax. The rate depends on how long you held the property. Short-term capital gains. If you held the property for 1 year or less, the gain is taxed at your ordinary income tax rate. Long-term capital gains. If you held the property for more than 1 year, the gain is taxed at a reduced rate, typically 0%, 15%, or 20%, depending on your income level. Depreciation recapture. If you claimed depreciation deductions on a rental property, the IRS requires you to recapture the depreciation when you sell the property. This recaptured amount is taxed at a higher rate, up to 25%. Transfer taxes. Many states and municipalities impose transfer taxes on the sale of real estate. These taxes are typically based on the sale price and vary by location. Now let's explore some strategies to minimize tax liability. Navigating the tax implications of property transactions can be complex, but several strategies can help minimize tax liability. A 1031 exchange allows you to defer capital gains tax by reinvesting the proceeds from the sale of one property into another similar property. This strategy is popular among real estate investors seeking to grow their portfolios without immediate tax consequences. It's important to follow specific IRS guidelines to qualify for this exchange. Then there is the primary residence exclusion. If you sell your primary residence, you may be eligible for an exclusion on capital gains. Individuals can exclude up to $250,000 of gain, and married couples can exclude up to $500,000, provided they meet certain ownership and use requirements. This exclusion can significantly reduce or eliminate your capital gains tax liability. What about installment sales? An installment sale allows you to spread out the gain over several years by receiving payments in installments. This can help reduce your taxable income in any given year and potentially lower your overall tax rate. This method can be particularly beneficial for large sales that would otherwise push you into a higher tax bracket. There is also the option of establishing charitable remainder trusts, CRTs. Placing property in a CRT allows you to receive a capital gains tax discount. You transfer the property to the trust and designate a charity as the remainder beneficiary. You receive income from the trust for a specified period or for life, and at the end of the term, the remaining assets go to the charity. This strategy not only reduces your capital gains tax, but also provides an income stream and supports a charitable cause. How about donating property to a qualified charity? Donating appreciated property to a qualified charity can provide a 100% tax write-off based on the property's fair market value. This strategy allows you to support a cause you care about while receiving a significant tax deduction. It's essential to ensure that the charity is qualified under IRS rules to receive tax-deductible contributions. Buying and selling businesses are considered part of property transactions for tax purposes. When you buy a business, you acquire its assets, which can include real estate, equipment, and intellectual property. These transactions can have significant tax implications, including asset allocation. The purchase price of a business must be allocated among its assets. This allocation affects the depreciation and amortization deductions you can take. Goodwill. The portion of the purchase price that exceeds the fair market value of the acquired assets is considered goodwill. Goodwill can be amortized over 15 years for tax purposes. Capital gains. When you sell a business, the gain or loss is typically treated as a capital gain or loss. The tax treatment depends on how long you owned the business and the nature of the assets sold. How does this work with intellectual property? Intellectual property, IP transactions, can also have tax implications. IP includes patents, trademarks, copyrights, and trade secrets. When you sell or license IP, the income received can be subject to different tax treatments. Capital gains. If you sell IP that you have held for more than 1 year, the gain may be treated as a long-term capital gain. Ordinary income. Licensing fees and royalties received for the use of IP are typically treated as ordinary income. Amortization. IP acquired through a business purchase can be amortized over 15 years, similar to goodwill. Let's take a look at some real-world examples of property transactions. John is a real estate investor who owns several rental properties. He decides to sell one of his properties, which he has held for over 10 years. By using a 1031 exchange, John can defer the capital gains tax on the sale by reinvesting the proceeds into another rental property. This strategy allows him to grow his real estate portfolio without paying immediate taxes, thereby maximizing his investment potential. Jordan owns a small tech company that has developed valuable intellectual property, including several patents. When a larger company offers to buy her business, Jordan negotiates the sale to include a significant portion allocated to the patents. This allocation allows her to treat the gain from the sale of the patents as long-term capital gains, benefiting from the lower tax rate. Additionally, she uses part of the proceeds to set up a charitable remainder trust, which provides her with an income stream and a capital gains tax discount. Eric owns a piece of appreciated real estate that he no longer needs. He decides to donate the property to a qualified charity. By doing so, Eric receives a 100% tax write-off based on the property's fair market value. This generous donation not only supports a cause he cares about, but also provides him with a substantial tax deduction, reducing his overall tax liability for the year. Michael holds a significant portfolio of stocks and cryptocurrency, both of which have appreciated substantially. He is planning to sell a commercial property that has also increased in value. To offset the capital gains tax from the property sale, Michael donates some of his appreciated stocks and cryptocurrency to a qualified charity. By doing this, he not only avoids paying capital gains taxes on the donated assets, but also receives a tax deduction equal to the fair market value of the donated assets. This strategy significantly reduces his overall tax liability while supporting charitable causes. Property transactions, including real estate, businesses, and intellectual property have significant tax implications that can impact your financial outcome. Understanding capital gains tax, depreciation recapture, transfer taxes, strategies like 1031 exchanges and primary residence exclusions can help you make informed decisions and minimize tax liability. Additionally, leveraging charitable remainder trusts and donating property to qualified charities can provide tax benefits and support philanthropic goals. Thank you for joining us on this episode of 5-Minute Finance. In our next episode, we will explore business taxes and the benefits available to business owners. Remember, financial fluency is a life skill, and we're here to help you master it. Stay tuned for our next episode, and don't forget to subscribe and leave a review. Until next time.